This is amazing. I'm Bunny Ellerin, and I am now the CEO of DHNY, which we'll get to in a second. But welcome. This is our signature event. Every February, we kick off the year with Where Will the Money Flow? And this is the first time that we're back since COVID. In fact, the last event that we did was February 2020, and then COVID hit. Many of you know that we were NYCHBL, New York City Health Business Leaders. After 14 years, we are now part of a new entity called DHNY, Digital Health New York. So now I want to turn it over to Ron Fleming at Pillsbury.
With no further ado, we're all here to talk about where the money's going. At the end of the day, transactions, building things that need to be built, solving some of the biggest problems we have in the universe. It doesn't happen without the grease of cash. So I think we have an esteemed group of panelists here that I'll let them do some quick intros of themselves. But we'll start with Nimi. You want to just give a brief intro for the group?
Sure. Hi, so nice to meet all of you. Thank you so much for being here. My name is Nimi Katragada. I am a partner at Box Group. We are an early stage venture fund, team of 7 investors, and we're generalists, so we actually invest across a number of sectors, but I personally lead our healthcare efforts, spend about 30 to 50% of my time focused on healthcare. And we're typically investing in founders at the earliest stage. So we are investing as part of the first institutional seed capital that that companies are raising. And so it's really special to kind of be part of, the first ideas and the first pitch conversations. And then we continue to invest and follow on as the companies grow and scale. And, we're proud to be investors in a number of the companies sort of based here in New York, like Roe, Alma, Tomorrow Health, and others, and invest all across the United States.
Hi, my name is Julian Harris. I'm an operating partner at Deerfield, which is a New York-based healthcare investment firm. We're a diversified healthcare services firm and also do biotech and medical device investing. We are stage agnostic, so we start companies from scratch and do early stage investing all the way through later stage growth equity, crossover rounds, and public investing. We are very focused as a healthcare services and technology team on digital health and value-based care. I'd say thematically are 2 of the big areas where we've done quite a bit of investing. I've worked on 14 investments across those 2 spaces primarily, and a bit on the kind of nexus of diagnostics and digital health. We're really excited to be here. We are very invested in the New York ecosystem. We have a building in the Flatiron area called the Cure Building, where we host biotech companies and digital health companies and med device companies and incubators. And so would love to continue to meet new folks and partners. We continue to try and support the thesis that we're hoping to be a part of proving, which is that New York is the center of the healthcare universe.
The hot act to follow. Hi, everybody. I'm with Inside Partners. I realized today I'm actually wearing the firm colors, and that wasn't planned. If you go on our website, orange and blue are our colors. So there you go. I'm a walking advertisement for. So we started as a venture firm, and I joined the firm 20 years ago. So I'm definitely part of the furniture at this point. Inside at that point was very much VC, and as we started to realize that tech companies scale up, we recognized that there was an opportunity to put more capital to work. And so now we do private equity as well. So really span kind of startup to scale up to IPO. Our healthcare investing is relatively new. I'm looking at Yen over there because she and I were working with Medidata. It was one of the first healthcare investments we made, which is obviously a big New York name. But today we have 44 investments. We've got about $3 billion invested in those 44 investments, all the way from really early stage to much later stage. And so not New York centric necessarily, but several great names in New York as well, including Elmer, which you know about, Gamido, and a couple of others.
Great. And I was wondering how Bunny did the ordering. I see it's earlier stage to later stage, so that was very smart of you. Fletcher Gregory, I'm a principal on the healthcare team at General Atlantic. We've been in the growth equity business for 43 years. Business is international. We deploy 7 to 8 billion a year, both in the U.S. and outside of the U.S. I spend all my time in healthcare. We have six different sectors that we focus on. On the healthcare side, we have a pretty wide mandate. We can do anything from new company formation all the way to full buyout. We're typically coming in the Series C, Series D plus stage all the way through IPO, and are looking to write, call it $100 to $300 million equity checks. Key focus areas for us, not too dissimilar from others, have been in value-based care, digital health, behavioral health, and payer and provider-focused technology platforms.
That's fantastic background. So I think we cover the gamut, and I'll just say 2 seconds on Pillsbury, as do we. We're humble lawyers here, but we do pride ourselves on getting financings done faster and as well as anybody, and take a lot of pride in helping get things done well. And we recognize that a lot has to happen and has to happen fast. So with that, I'm going to kick it off. So look, big picture, we all enjoyed a 2021 bonanza in every market, right? And healthcare and health tech was no different. At least some of the statistics I saw, we went from about $56 billion of investment in 2021 down to $33 billion last year. And especially, the first couple of quarters were some that seemed to be maybe some stabilization in Q4, but still above 2020 levels and, above historical levels, just like VC generally. So, kind of everyone, it's crystal ball time. We're here at the beginning of the year. We heard last year, I remember in the M&A world, a lot of forecasts that it was all going to happen the second half of last year. Didn't happen in general. So crystal ball time. I think that's why we're all here, to try to figure out where we know kind of where we've been, where we're going. And I guess, let's start with you. What's your prediction of what we look like in terms of the number of financing dollars for this year versus last year, for example?
Yeah, I mean, my prediction is we're lower. I think that we are. I can speak to the early stage environment. I think for us, we have already found that the start to this year has been slower, and our pacing has been slower. I think in a way we would have maybe thought that the early stage market would have been more insulated, and I think it is. But I think there's a couple of dynamics at play. I think we probably as venture capitalists pulled forward a lot of activity in 2020, 2021, even the first half of 22. I think a lot of folks who would have started a company saw very frothy markets and took advantage of that and raised capital. So I think right now we're sort of digesting that, and there are probably a lot of folks who ended up starting companies maybe a little bit earlier than they would have. And I think the second thing is I think founders sort of see that the market has changed. We hear how there's whispers of it's harder to raise, more to prove. And so I think that hopefully in a healthy way, we're actually maybe seeing folks diligence their ideas more and kind of get to more proof points before raising. But yeah, I think that for those combinations of, I think definitely lower, and certainly on the growth side, it's been quite lower. But
so we're going to continue that you're predicting the trend is
we'll
lower than even 22. Julian, your thoughts?
Yeah, I think probably the themes I would highlight are more consolidation. So we're seeing, companies that raise being in a position in certain cases to acquire either with cash or through just kind of stock deals, companies that didn't raise, or that are just looking to be a part of a bigger, sort of better finance platform. I think we're seeing a lot more structure, and you think about structure as being something that happens later stage and in growth equity deals, but we're seeing some structure even in some early deals, not just lower prices, but actually structure in certain cases.
I'm going to interrupt you there, Julian. My favorite word, Taylor, our favorite word, structure. The biggest
legal fees.
For people that don't know what that means.
All right, did I say that? I'm sorry.
Yeah. Yeah, it means you're getting screwed. No. But it's the euphemism of the day. It's not just in healthcare. It's really as soon as you hear that word, watch out, right? The NVCA forms don't cover it. Okay, sorry. Hillary,
I think it's a little more nuanced than that. It can mean many different things, and there's sort of different flavors. In one version of the world, right? Converts can be conceived of as structure and can be structured in different ways. So, I think what it's providing is people with on the entrepreneur side, it's providing people with, honestly, access to capital in a sort of complicated market, and the investors are looking to de-risk because, it's harder. Their fundraising is sort of a different environment as well, not just for the companies, but for people who are raising funds. So I think that's, sort of a phenomenon. Obviously, when things go well, you sort of work your way around it. It's really kind of more what happens, when things don't go well. So that's one big thing. And then I think the other piece is just, particularly in digital health, I think there is a broader recognition that point solutions are just going to have a harder time breaking through in conversations with both health plans and health systems. And so people who have platforms that are integrated are just getting, I think, more traction. And the people who have things that are sort of very bespoke in certain cases are, to point one, looking for someone to potentially combine with.
I bring back, and just picking up what you said, Julian, the massive amount of digital adoption and digital transformation that was happening during the COVID years, where people were bringing forward spending that they may have, slow rolled through the current years. Companies are digesting that. The payers adopted a lot. The providers adopted a lot. Life sciences adopted a lot. And they're going through a process of saying, am I getting the value from what I thought I was buying? And so I think if you just sort of take it back to the macro perspective, there's the trickle-down effect from the public markets. When interest rates rise, valuations in the private markets are inversely correlated because there's a flight of capital to credit markets and other places where you can get a decent return. And so, there's been just less capital in the private markets in general, and software companies, the bloom is off the rose. And then you couple that with the fact that the actual buyers of software are sort of more circumspect. They're being asked to produce more profits in a macro environment that looks like now, and they're more reluctant to buy. So I think the confluence of those two things means valuations are tougher, fundraising is harder, just takes longer, and the delta between the bid-ask spread is wide, and hence you're just not going to get as many financings until that bid-ask spread narrows. And so you ask, well, when will the bid-ask spread get to narrow? And that's when all the companies who raised gobs of money 12 months ago, 14 months ago, run out of cash. But right now they're just digesting what they raised, and there's no reason for people to raise. Different in the early stage because they didn't raise, but in the later stage, people have a lot of money and they are now spending it more prudently. So I think that's why you'll see. It's a long, convoluted way to say there are less transactions that will happen this year.
We're starting to see. By the way, you're wearing the blue and orange for the New Yorkers in the room are also the Mets colors, right? And I like to tell people that the 101 wins the Mets had during the regular season were as relevant on October 15th as last year's valuation was to your valuation now. It's i.e. there's no correlation. So we're starting to see conversations with folks. I'm curious and pleasure of your view, but we're starting to see conversations that have started to happen with competitors and maybe some natural consolidation where the bid ask was really, really wide. And the reality is coming back that, they have 5 months of cash left, and the reality of Mr. and Mrs. Market speaks, and they're back in surprise in dialogue about a merger again. So we're starting to see that some of that trend.
So he can tell you about bid ask spread.
So with Fletcher, are you saying? I guess I'll ask you about that, and also call it maybe the trickle down effects of the changes in the capital. I guess we went from the best of all worlds to the worst of all worlds, and in the best IPO market ever in 21 to the worst ever on record in 22, and all those trickle down effects. How you think about those and with some of these dynamics?
Well, I do think that's relevant. Obviously, with S&P last year for the first 9 months dropped more than it has in a century, and so you had the capital markets that essentially shut down. And when the IPO markets were wide open a few years ago, you had a lot of crossover rounds, you had a lot of pre-IPO rounds, and a lot of companies that went public that probably shouldn't have been public. Since that shut down, a lot of those companies aren't raising now. You've seen some crossover investors that have left the market. I guess getting back to the fundamental question of number of transactions or deal, I'm going to remember the exact question of compared to last year. I think it's a little nuanced. I think in the second half of the year, I think you probably could see year-over-year growth in the number of transactions for the reasons we just mentioned. I think the IPO markets are likely to start to open up. I think you're going to see a scenario where a lot of companies start to run out of cash. And I agree. I think a lot of employers, I think a lot of payers have piloted a lot of programs, and they'll become much more rationalized with their vendor base. And then some of these companies will ultimately have to expand into new service lines, into new products, and that they can't do organically because the funding market's not available. So I think a long way of saying, and anecdotally in the later stage of the market, we've seen some companies that are in bank processes or that are coming to market now that are generating a tremendous amount of demand. It's a surprising amount of demand. And so I think that companies are going to see that bid-ask spread is continuing to narrow. It's pretty wide in Q4. We've already seen some transactions that haven't been announced yet to show that it's narrowed some. There's some strategics coming in, which may not be the direct question. But I think what you're going to see in Q1 and Q2 is some transactions that are announced. And when you talk to any sort of banker on the street, they have this huge pipeline of deals that they're just holding back. I mean, they're just literally just pulling these back, waiting for those first few transactions. And I think when those first few transactions hit, they're going to be rushing these companies to the floodgates. And there's so much capital on the sidelines. I'm actually a little more bullish on number of transactions that'll occur this year. I think it'll take a while to get there. It'll probably more the back half of the year, but I think year over year, you're going to start to see some significant growth over 22.
So Hillary, I'll throw this one at you. So, we saw here at Pillsbury and from others in the market, I think statistics bear out that the early stage did remain relatively robust last year compared to maybe certainly the later stage, not just in healthcare, but just generally in venture. And just curious, is that what you're seeing at Insight? And I think Nimi, you alluded to maybe you think that's maybe changing this year already. Are you seeing? Do you agree with Nimi? Are you seeing the same thing?
Yeah, I think a lot of deals were being done in the early stage because there was no value to be had in the later stage. There was such a load of FOMO. Companies were, let's just call it healthcare imposters potentially. Even you go back a couple of years where folks hadn't been software investors, and we've been software investors for years, as have you. And suddenly everybody realized the SaaS business model is a really attractive business model, has long-term recurring revenues, has high visibility. We should all pile in. And so you got a lot of people who didn't know anything about ARR, gross, net retention, all the metrics that really matter piling into software. And I think COVID did that for healthcare. Folks suddenly realized massive industry opportunity, huge consumer adoption. Diagnostics are in the home; they never were, et cetera, et cetera. And so people were piling in. And now I just wonder whether. So long story short, I think a lot of people were with a lot of money were in the market and therefore bidding up prices. Whereas in the early stage, you had to know what you were investing in because it requires a deep understanding of the market, as opposed to in the later stage, you can just look at the metrics. You can say, what's retention rate, what's growth rate, what's your cost of customer acquisition. You can look at the metrics and invest without really understanding the market opportunity. I think in the early stage, you have to understand healthcare. And so that's where I think the disconnect is. Why early stage still saw a lot of funding, because I think the existing folks saw there were value and could lean in because they understood the market. And you saw a attraction of capital for those who saw healthcare as a good spot to put capital, but didn't fully understand it. It's just 1 point away.
So it's funny. So Julian, I remember vividly back in 2002 and 3, where there was a lot of conventional wisdom out there that, hey, with a similar dislocation in the public markets and the like, that early stage actually is the best place. The best time to be starting a company is when the IPO market shut, because it's that much more likely to be open when I need it 5 or 7 years out. So, any thoughts on those kind of dynamics?
I think, we have some of those conversations. Where are we in the cycle? I think there's also like a misperception that there's a benefit for an early stage company to launching with a big valuation and lots of expectations. And I'm not sure that actually proves out. I think we're seeing sort of the opposite of that in certain cases. So, I think it's in many ways sort of a better place to be in launching a company right now, getting a valuation that makes sense, having a chance to grow into it and sort of have proof points, have an ability to deliver for your investors so that your current investors want to put more money in instead of, looking at you and saying, do I even want to put more money into this company, right? So I think that cycle can actually be to the benefit of folks right now.
Great. So related to all these dynamics here, so I think for a show of hands, how many founder types do we have in the room? Do we have a fair amount? Great. So I think some of the burning questions that I'm sure you all have are, and some of you, I think Fletcher, you alluded to them. How have the call it the metrics and the expectations changed in the pitching dynamics when talking to investors? how have that's changed in the last 24 months and how should founders think about that as they're approaching VCs and in terms of how much money they're going to burn and ROI and all those kind of metrics. So, Fletcher, you want to try starting on that one?
Yeah, sure. Maybe to answer the question, I'll talk about an analysis we did recently where we ran 2 regressions, one on valuation to revenue growth, one on valuation to Rule of 40, which is revenue growth plus EBITDA margin. These are for high growth healthcare public names. A year and a half ago, the correlation between revenue growth and valuation was almost perfect, very tightly correlated. Essentially, everyone is being valued based on revenue growth. Today, that's a scatter plot with a lot of, it looks like a shotgun blast onto a chart. There's essentially zero correlation, whereas the valuations relative to Rule of 40 are very tight today. And so clearly revenue growth is important and is a component. It's no longer the independent variable. And so I think, I guess the question is sort of how should founders think about pitching? I mean, I think our North Star has always been an establishment of unit economics. And fundamentally for each new customer or each new patient, are you essentially making money on that patient? If you're not, you're either not getting paid enough for your services or you haven't figured out a care model or a delivery model to deliver your services efficiently. I think that's even more critical today, whereas, a couple of years ago, you could show negative gross margin for a few quarters with the idea being as long as you acquire as many customers as possible, you'll find your way out of it, ultimately scale to where you have a profitable business. So I think that's the most critical component. I mean, obviously we've all had to, whether it's through layoffs or through, tough decisions, we've had to manage cash really tightly over the past year or so. I think continuing to show your ability to drive growth while prudently managing your cash balance is going to be critical for any investor. And the second thing, which was important before, but I think even more important now, is just as there's this huge washout of potential names that were just slideware and showing ROI that wasn't actually proven, is an improvement in clinical outcomes and showing a hard ROI in a short period of time. Not an estimate of what it'll be in 5 years, because I think whether it's on the employer side or on the plan side, it's going to be a much higher level of scrutiny and improvement in outcomes over time.
Julian, do you agree with that?
I do. I mean, I think the other thing is, just sort of thinking about this from different stages and what the opportunity is in the moment instead of kind of a more pessimistic view. Because there was so much capital, I think it allowed entrepreneurs and really their boards and their investors to be less disciplined. And so you sort of get to a place where people haven't really been thoughtful about unit economics and thoughtful about how they, sort of balance, sort of staffing ramp. And as a consequence, just read, any of our blogs or, sort of industry rags, and you just see like this company is doing RIF, this company is doing RIF. It's just sort of like the daily drumbeat. Some of that is just really kind of lack of discipline in some ways, right? And you can do that in a market when there's a lot of kind of excess cash and sort of less. I think about pharma. No offense to anyone who works in pharma, but I remember in business school learning how some things work in pharma and being pretty amazed. But pharma companies could be for a long time not as disciplined because of just some of the ways that industry is structured, and some of that percolated over into healthcare technology businesses. And I think now you're just seeing a lot more focus on thinking about unit economics from the beginning, thinking about how you do your own staffing ramp in a more responsible way, and thinking about how you leverage technology as sort of a true disruptive force to drive kind of efficiency from a labor perspective is going to continue to be a big focus.
So Nimi, how far? I mean, again, we all sit in board meetings all year long. I'm sure you guys go to hundreds of them where you sit. And that drumbeat, that's a good word for it, of you're not growing fast enough, you're not growing fast enough. Many, it's kind of funny, many boards had started a practice of breaking out regular hiring and tech hiring, because that was the biggest issue. The biggest problem companies had 24 months ago is they couldn't hire tech folks in New York and beyond fast enough. That was literally the biggest issue. And the pendulum, I'm curious, how far have we swung from that pendulum as with these massive amounts of layoffs? And how do you think about all that new talent that's emerging in the marketplace as, again, go back to, business school, maybe the bottom 5 or 10%, maybe you should clean out every year anyway. But there's some meat going out with this massive amounts of layoffs.
Yeah, I mean, I think we clearly really swung the pendulum. And, one thing we talk about is like, it's founders and investors both, right? Like, I really empathize. We've had a lot of tough conversations with portfolio companies, and, there were board members in that room that were equally emphasizing grow, right? So I think founders and CEOs were responding to that. So I think almost everybody has to take accountability because I think it's not fair otherwise. But yeah, I mean, I think now we've really swung on the other side. I think as like a net new founder, the actual core tenets of like pitching your company and vision are really similar to what they have been a couple of years ago. I think, as Hillary said, a lot of it is like what market, like what's your unfair, advantage, what's your market insight that nobody else is seeing, and then coupled with team. So I think that is still very much the same. But yeah, I think at the growth stage, we've like really swung to the other side again, probably in a healthy way, but I think in a potentially really painful way. I do think there's a lot of talented people amongst all of this, and that's why I think like it could be a really ripe time to start a company. I think transcendent companies are sort of built at all times. I think it's not your job to market time, it's your job to focus on your company and your idea. And so I'm very optimistic that I think in the back half of this year we'll have some amazing quality of early stage founders, and like you said, they'll have hopefully another amazing IPO window in 7 to 10 years of their overnight success.
Well, I agree on everything, and there are no engineers. So the engineers are not being laid off, and that's where the scarcity is. So, I'm on several distributions lists of all sorts of companies from Slack to Zoom to Google and all these folks who are being laid off. And I can tell you, 2% of all people laid off at Google were masseuses. So 240 masseuses were laid off because, that's where the hubris had gone. And the other,
We're hiring here, just so you know.
Thank you.
The Seuss's, well, what's out?
Structure.
So yeah, Google laid off 12,000 people and 240 were masseuses. And so the other folks that are being laid off are the TA teams, right? The talent acquisition teams. Everybody had staffed up with all these recruiters because, you needed really in-house recruiting in order to hire. But I'm not on all the lists I'm not getting a lot of engineers up for grabs. And to be honest, that's where the scarce resource still lies. So, yes, the labor market is better, and a lot of people with deep domain expertise are on the market, and I think that's fantastic. But to actually, if you're in the software investing industry, we care about engineers. It's still a scarce resource.
Good to know. Well, I'm going to pivot a little bit to maybe some specifics. So I'll start out with one that virtually everyone in the room, I'm sure, cares about, given that I guess the statistics are all of us in one degree away from some mental illness, addiction, or both. And historically, this industry has attracted roughly 25% of the capital that's gone into health tech, broadly defined, has gone into mental health. And that segment, notwithstanding the crises everywhere, and if you know anyone that needs mental health help, other than checking into emergency room things, try to get an appointment. I mean, it is stunningly bad, these big problems, but yet we had 49% decline year over year in mental health. So, Julian, why is that?
Again, it's sort of a pendulum question, right? So, we had a lot of focus on the sort of impact of COVID on people's mental health and investment in, digital and tele capabilities and big valuations, particularly in the public markets, at least initially and for a while. And like so many things, right, as the market sort of, I talk a lot about the physics of healthcare, right? So there are things that defy the physics of healthcare, and that happened in certain aspects of health services, but it happened in some of the behavioral companies as well. There are obviously also labor challenges that have made it difficult, because at the end of the day, yes, there's some companies that are largely, text-based or chat-based or AI-based, but most of the companies have some sort of labor on the back end, and that market's become more competitive over time. So, I think some of the things that I am seeing that are the most interesting are people, trying to figure out some combination of labor arbitrage or sort of, practice at the top of the license. How can you enable, a psychologist or social worker or something to work with a lower skilled person to provide support with them sort of supervising, and some combination of that with technology. And then there's some companies that are focusing from a specialty perspective. So, we're seeing, eating disorder focused companies, or companies focused on sort of the nexus between mental health and weight gain or weight loss. So some of these kind of more bespoke companies, I think, are are more interesting and probably getting more focused than the, hey, we've got a big network. The other kind of funny thing that happens is, a lot of the companies that were sort of like mental health MSOs, but weren't signing exclusive contracts, they're working with the same providers, right? And so at some point, like, it looks like someone will pitch and say, like, we've got this network of like X hundreds or X thousands of folks in Y states. But you kind of do the math and you look at 2 or 3 of them, and it's just like, again, physics of healthcare. There's just a lot of overlap. And so really having something that is kind of curated and proprietary, I think, is more rare than common.
So one more question. Fletcher, any thoughts on that topic?
Yeah, and so the prompt was why did funding in behavioral drop from 21 to 22? Is it? Yeah.
Right. I mean, it's obviously one of the major issues of our time. I think when
Yeah.
people look back at this period of history with the addiction deaths at all times high, the crisis of the Generation Z. I mean, a lot of things happening.
Yeah.
So
I think that's a little unfair. I mean, if you look maybe 5 years ago compared to 22, you're going to see huge growth. So, I mean, 21 was, a record year. So we're very bullish on behavioral health broadly. And I think with the main, really the umbrella reason for that is we're moving from reactive behavioral health care to proactive behavioral health care, as opposed to waiting for someone to walk into the door, try to provide access, which typically led to long wait times, typically led to bad outcomes. We now have the data and analytics tools to be able to stratify and risk assess a population, to be able to drive engagement sooner. We now have, obviously, virtual care. I mean, even a few months ago, I think over 50% of behavioral health visits were still done virtually, which provides access to rural areas. It increases health equity on the behavioral side. And we're also starting to see a standardization of outcomes in the space, which I think will lead to, providers that can start to take on more risk, which is great for the industry, because I think it will shift a lot of that volume to high quality providers that focus on outcomes, and it'll become a bit of a virtuous cycle as they're able to build a broader moat, build the technology engine that will allow them to take on risk, drive the, EBITDA profitability that will allow them. It becomes a bit of a virtuous cycle. And so I'm excited about, particularly with integration with primary care, the industry moving to a place where it's no longer just provide access at all costs and provide high quality access.
So I'm going to ask each of you to pick call it your top 2 therapeutic themes or areas that you're particularly bullish on for the next little while here. Nimi, you want to start?
Yeah, sure. The first one that I'm interested in spending a lot of time in is the intersection of fintech and healthcare. I think that, coupled with a lot of these challenges around care delivery, we also have a large affordability challenge. And so how can we innovate on that? We have a couple investments in that space, but I think we're going to start to see a lot more at the intersection of fintech and healthcare, even for providers as well, as they just think about managing their practices and doing that in a more efficient way. So definitely really excited about that. And then, the second one, I mean, echoing sort of a lot of what was said here, I still think we have a lot to be done in behavioral health. And so, we have a couple investments in the space, Alma, another one more focused on children and adolescent health. And so I think that we're just seeing the demand for those services, the outcomes, as Fletcher was mentioning, and I think we still have a lot more to do in that space.
So I think, there's a lot of opportunity kind of focused on high cost conditions. So we've done quite a bit around some of the big sort of expensive areas like kidney care, cardiology, oncology, orthopedic. So I think that'll continue to be a focus. And I think you're starting to see some folks say like, hey, but what's sort of 5 through 10? So, we have a company, for example, that focuses on multiple sclerosis, Octave Bio. But I think that thesis is just sort of aligned to kind of where the push and pull points are for U.S. healthcare. I do think behavioral health is an interesting and important one. As you heard in one of my prior answers, I'm pretty interested in kind of the nexus of behavioral health and this particular condition, because there's some chronic conditions that have a pretty unique sort of associated behavioral health manifestations, and companies that are thinking about the nexus of those two things, I think will have some opportunity as well.
Diagnostics. I think we've only just started to really tap what diagnostics can be, and the fact that we've all got used to sticking something up our nose. Hopefully there's going to be better ways to do home diagnostics in the future. I think Roche announced at JPM that, PCR machines had been up, 150%, which makes sense because they're much more ubiquitous. But I think what we're really haven't started to figure out is how the mobile device is going to be a massive diagnostic tool. So, using your mobile device, you can look at mobility and stride. You can look at, hand-eye coordination, visual acuity. You can do an ocular scan and understand inflammation in the body, and they're doing a lot of that around MS. And so I think, the actual diagnostic process is, not Theranos, notwithstanding, there is a lot of new diagnostic stuff which is coming forward that is really exciting. We've invested a lot around diagnostics where you're supplementing with AI and machine learning the actual expert in the room. So Screen Point Medical, is looking at mammograms, and the mammogram plus the radiologist, is able to diagnose with significantly more accuracy than any one of those alone. The same with Viz AI, which is for stroke detection. So a lot. Idovan has got all cardiograms in the cloud, which any cardiologist can access globally as kind of Snowflake, if anybody knows the tech version, but Snowflake in the cloud for cardiology. So amazing way to kind of understand patterns and trends. So diagnosis is one. The second is things moving out of acute care into more of ambulatory setting. There is a massive trend towards that, but not just that. Hospital at home is a thing. Aging in place is a thing. And I think all of those are going to present opportunities for software to make a difference, both in terms of, providing data that allows people to make better decisions in those environments, and also kind of healthcare superheroes, for want of a better word, where I think you mentioned empowering people who are not necessarily qualified to actually engage in more quality kind of care. So, for example, we invested in Forta. There's a massive lack of so this is also tied with labor shortage, but there's a huge lack of folks who know how to do autism support, and Forta actually helps the mom or the parent do a lot of the interventions that an actual therapist would do, because it's like Hinge Health or any of those things where you've got it and it tells you what to do. So I think those two things, ambulatory and more kind of out of acute settings, and diagnostics.
Fletcher, you're finishing us off here before we go to Q&A here.
Great answers. Yeah, my mic's on. And I agree, particularly with Julian's sort of thought process behind which other subspecialties can you start to take on more risk. And we've had some success in different care settings like primary care and in the home with sort of polychronic MA members. But and then in addition to that, there are still pockets within behavioral. To be a little bit more specific, we think individuals with serious mental illness has shown that they drive 2x the medical spend. And so I think curating models that are specifically focused on driving engagement and treating that condition is important. You mentioned autism. Autism is an area, it's a bit contrarian now because there's a lot of scaled platforms that have struggled during the pandemic, have shut down services, but there's still a massive unmet need. 1 out of every, I think, 46 8-year-olds is diagnosed with autism today. And I think that something like only 20% of the authorized or diagnosed hours can actually be filled by providers. So I think there's a huge unmet need there. And you just triggered a thought. You mentioned the labor shortage. I mean, when we think about the biggest issue that we're all dealing with across our services platforms is that exact point, and our ability to hire up whatever clinical type. And a lot of the challenges are that you can't necessarily create supply in the space. And so I think there are some staffing platforms and the like that are sort of a temporary fix. But I think there are technologies that can drive efficiencies, reduce administrative burden, drive efficiencies within the provider organization that can reduce physician burnout, that will ultimately artificially increase supply in the form of higher productivity. And so technologies focused in that area are interesting to us as well.
Fantastic. Well, I can't, Hinge was mentioned, but we represent, call it their arch rival, Worry. So can I moderate a panel out that Ryan couldn't be here tonight, he was supposed to be. So Worry is great too. With that, opening up the floor to questions. Do we want to use mics for this, or?
Thank you. My name is Andre. Does it work? Can you guys hear me, or should I speak up?
Yeah, just project. Yeah.
My name is Andre. We're on a AI-driven diagnostics and treatment recommendation in musculoskeletal care. ChatGPT made a lot of waves recently. A lot of investors are excited about AI. It looks like it's a new renaissance for AI. Do you see a lot of this in healthcare, and what excites you in particular in healthcare? What applications of AI, if any, excite you the most? Maybe you should repeat the question.
So also, I think the questions to the panel here is which parts of with all the excitement going on in the AI world right now for this panel and at the intersection at a digital health conference, what particular aspects of AI are kind of focus of the group up here?
I'm trying to decide if I can say this. I think I can. I don't see any video cameras here, so I'll just say it. I have a very good friend who works at our now famous chat company. We ain't seen nothing yet, I guess is the thing to say. Like, this was not, they didn't expect this to be a big deal. This is not a big deal to them internally compared to things that will be released in the not too distant future. So more to come. Put that in a box. Gosh, I guess what I'd say is I think that, certainly just kind of taking the natural extension, right? There are a lot of companies, including, some of the behavioral health companies that we were talking about earlier that, have tried to think about how you can leverage artificial intelligence to create, effectively labor efficiencies or to address some of the labor challenges that we were talking about earlier or shortages. That's interesting. I think that it's clear that it's not enough, right? So Talkspace, in the behavioral health side was probably at least the one that got the most attention for that. And something's not quite humming there in the way that, we'd want, or at least the kind of public market reception of it and scalability of it. So I think that's probably the area sort of thinking about it in the nexus of chronic condition management that'll be interesting to follow. There are a whole bunch of examples that I think we all now know were probably overblown. But I think that's probably the one that we're most focused on is, can you actually use it to think about how you collaborate with patients more intensely and or with providers to manage chronic conditions?
I would add one thing, which is there's a vast difference between AI and machine learning, and most of the products on the market today are machine learning. And I think we can get a really long way with just machine learning. So, these enormous, massive data sets, I mean, they're untapped, and we haven't really, I think, applied true AI to the kind of results that you can get from them. But I've actually yet to see a really amazing AI company. I see a lot of amazing machine learning companies that are using a ton of, algorithms and rule-based, stuff to support both patient care as well as the provider make better decisions or the payer make better decisions. So it's just, I think AI is on the come. I don't think we're really there.
Yeah, I so agree. I think that even more broadly zooming out from healthcare, I think like the application layer of AI right now, we're like just scratching the surface, and we're actually probably seeing more toys than companies, but I think that's like the common thing, usually with transformative technologies.
So this is AOL, like 92.
Yeah. Right. I mean,
CompuServe, go to Sears,
I think
get a line.
Yeah, or mobile. I think
Get around.
I think just like in the early
Part of the furniture. Who said that?
I think just like in the early era of mobile too, you had a lot of early mobile apps that were more like toys. And I think that like we will start to see very new and different like UI and interaction paradigms with AI. And I think when we build that workflow, that's going to be really interesting and powerful. I think it's not going to be just like ChatGPT 3 where like, you're typing something in, right? There will be such a rich sort of way of interacting with the AI, just like with mobile, you had, you scroll down, you tap, there's all this functionality. So I am excited about that as it applies to healthcare software. And even if we think about provider workflow tools, or like, could there actually be a new opportunity to build a new EMR that has a totally different type of interaction paradigm? I think it can be really interesting. I think it's going to take a while. I don't think we're seeing that yet, but I think it's very exciting.
I want to make sure we have time for any other questions. One in the back there.
Hi, Nadav Shimoni. I lead an Israeli-based digital health investment firm. I'm located here right now. And hopefully not being a downer, but we focus on the US market as an investor. and kind of like neglect the European market because there is a notion that there are a lot of businesses in the European market that can't really be venture. I mean, they're not growing as fast as they should as a venture business. Do you think right now we are seeing a group of companies that are essentially non-venture? Maybe there can be, great businesses, but they can't really grow as fast as they should as a venture. Maybe, Fletcher, to your point, I mean, the LTV CAC is not just, making sense as a venture. The, sales cycles in healthcare just take too long for them to be a venture.
Yeah. If I understand the question, I think yes, there are companies that have been funded that don't have an established unit economic model in place. I think that the question then is, well, where does that company go? And what I think what we touched on earlier is I think you'll have a lot of platforms that end up in some merger scenario, and there are a lot of complications with that, such as personnel, such as just determining relative value and the like. But if I'm understanding the question correctly, man, what we would expect to see those companies either unfortunately fail and have to shutter or merge with larger platforms. Did I understand the question?
Yeah, no, I mean, just to emphasize, I think, some plays are, they can be good businesses, but they're not suitable for venture investments because in venture you need to grow at a certain pace. And, I think it inherently relies on, what is the sales cycle length. I think over the last 2 years, maybe we were a bit fairly optimistic that we can accelerate sales cycles, but just pouring lots of money in. But healthcare is so hard and challenging sometimes, and things, certainly take some amount of time. So maybe some, I don't know, ideas are good as businesses, but not as venture. That's, I guess what I'm trying to ask.
I think it's 100% true. I mean, I think that we use the term tech-enabled services, but I think there's a huge spectrum in what that means and how tech-enabled actually is a service. And I think to your point, there are probably a lot of classic multi-stage tech funds who ended up going quite deep in healthcare investing, thinking there's a lot of tech here. And I think that they might realize there's not as much tech here as we thought. And that's going to happen for sure. And I think then we might see a lot of that pull back and not sort of be part of the healthcare funding climate as much.
Great. So we have time for one more. Eeny, meeny, miny. Let's do two quick ones. Can we do that? Don't yell at me, guys.
Thank you very much. My name is Gary Zammel. I'm actually here from Australia, so I know there are a couple of other Australians in the room. I want to take us a little bit away from digital, if that's okay. We are building a medical device company, so it's early stage. We want to obviously bring it to the US market very quickly, but establish first in Australia and move quickly here. How are your sort of investment groups viewing offshore entities that want to come into the United States market? And with the move from invasive medicine to non-invasive medicine and the requirement for smarter, more innovative devices to be used in a surgical procedure, is that a thematic or an area where you see that there could be opportunities and challenges for the future?
So I have what's usually the good fortune of being the only doctor on our services team. And so sometimes our medical device team calls me and asks me questions. So they let me pretend like I can sort of moonlight with them. I think the short answer is yes, right? There's a lot of, we actually, we're doing a pitch competition for a set of universities, and we asked for kind of digital health and health services investments and then broader kind of technology. And honestly, all the most interesting proposals we got were all medical devices. And, there's some pretty transformative things happening that will change kind of management in not only in the surgical suite, but sort of the inpatient surgical suite, but will facilitate, transitions in certain cases of more to ambulatory surgical centers, which, pulling back to the services side, like a lot of what's happening on the services side is sort of optimizing site of service shifts. So we think it's pretty interesting, and I'm not going to switch, but it's fun to kind of get to moonlight every once in a while with those folks because there's some neat things happening.
Last question.
Will that just work? Yes, brilliant. Hello, I'm Cassie Johnson with 11 Group. So we're a tech talent marketplace. We have a brand focused solely on health tech. We have fintech too. So I love what you said, Nimi, about the intersection of health tech and fintech. That's a trend we've noticed as well. You've spoken about what you're excited about and where you think the money is going to flow. I wanted to ask if you had advice for founders, maybe that what you're worried about. So maybe what's a fad rather than being a trend. That was it.
I mean, one area that we've seen companies trip themselves up in is exclusively focusing on direct to consumer without a core value prop, without a brand, without some leverage sales model or reoccurring sales model. I think as the past few years have shown, there's some direct to consumer platforms that have been highly successful. I think there are probably a lot more that haven't, and they've run into, there's just been this huge rush of advertising dollars to compete for patients, particularly private pay patients. And I think there's been an element of those individuals as savings rates have gone down, as we're entering into a recession. There was a lot of discretionary cash flowing around over the past few years. And so those companies that may have targeted higher income individuals out of network have struggled a bit. Some have done okay, but I think that's when we think about sort of a leverage sales channel, having it, whether it be in network, through an employer, through a payer, has been an area that we focus more on the B2B side. And so I think thinking really smart, if you're going into the D2C space, what's your brand advantage? What's your overall moat? Do you have an end market that will continue to be able to buy your services even in a recessionary environment?
Looks like there's one more. I know you guys wouldn't need to cut this off. This last one.
Sorry, so this is for this side of the room. So during the pandemic, we had a spike in cosmetic surgery, medical aesthetics, plastic surgery, hair restoration, men's health. So you guys talk about, primarily the insurance-based services like, behavioral health, diagnostics, pathology, cardiology. But the biggest spike during the pandemic was in elective cosmetic care. So what's your perspective? No one talked about it. No one talked about medical aesthetics, medical spas, cosmetics, hair, men's health. But these are emerging sectors. So what's your perspective on sort of non-insurance or elective cosmetic procedures? Because we've done well. I'm a founder of a elective cosmetic company. And I was panicked when COVID started. I thought I was going to go out of business, but it was the biggest surprise. We had pretty reasonable years, and we had a spike in business. So why is the focus on insurance, cosmetics, sort of the safe sectors, whereas you have an economy that's been resilient for many, many years, and yet private equity groups, venture funds don't seem to focus on sort of the out-of-pocket? Because insurance reimbursement is declining, but private pay is not. You have more and more financing companies. So what's your sort of perspective on these non-insurance elective cosmetic sectors?
I would say two things. You're in a massive growth industry because anti-aging is a big thing and nobody wants to get old. And so you're absolutely right. Like up and to the right, and Catterton just did a huge deal for a roll-up of all derm clinics in Canada. I don't know if you saw that deal, but it's a huge deal in which dermatological clinics with a single derm as a doctor are being acquired. That what they do is massive throughput on all things like Botox, et cetera, but also a common purchasing platform, a common payment platform, a common customer, relationship management platform. And so you're seeing a lot of that stuff. So it's not like no deals are being done. It's just not us. And I think partly because our focus in particular is on kind of hospital setting health or acute health as opposed to wellness. So that notwithstanding the fact that we're investors in Calm, which is a huge wellness app, and that there's a confluence of factors that lead to this. The reason Calm is doing so well is because people have a greater awareness of the need for sleep. The acceptance of meditation as a thing is more prevalent. You've got the handheld device, etc. So, and then employers recognizing that wellness is in their interests. So all of that leads to a confluence of why calm is growing. I think it's the same kind of thing. There's a confluence of factors that are leading to these non-reimbursable elective procedures that are happening, and that's very much around the society we live in, which is ageist. So I think it's more just that,
But don't you-
we are
wait,
not
wait.
focused there, but other.
Don't you mean us all staring at ourselves in the screen all day? Isn't that what you really mean? Well, look at it.
I don't think it has to necessarily be an either or. So we have some portfolio companies that are focused both on kind of chronic conditions and men's health, for example, or some of the more sort of elective, more wellness oriented kind of capabilities. It is sort of a little bit of a needle to thread, as Fletcher was alluding to, because some of those things really have more of a direct to consumer, go to market. And one of the things that I've spent a lot of time on is helping companies who start out that way try and figure out whether it makes sense for them to pivot to become B2B businesses. And we have a couple of examples of folks executing against that strategy well and having kind of, transformational kind of uptick in value and valuation. But I think it's, it'll be interesting to see, the derm sort of pieces is an example here, but there are some other things, I'll just use another example, right? So there's been a lot of focus on the GLP-1s as weight loss drugs. And obviously if, you don't meet the criteria, your insurance isn't going to pay for it, but people are paying out of pocket $1,500 a month. And so, it's going to be interesting to see sort of how that percolates over time. And people are thinking about how to actually, wrap theses around that. So.
Well, I think that's a great way to end this.